So remember what I talked about when I talked about financial statements, and one thing, the first thing I said is that financial statements are the responsibility of management. Auditors do not prepare the financial statements, right? That would violate independence if they did that. Auditors are providing an opinion on the financial statements about whether or not the financial statements fairly represent or present fairly in all material respects according to a financial reporting framework, which in our case is generally accepted accounting principles. And so that's the objective of conducting an audit on the financial statements. Management makes assertions about the amounts that are reported in the financial statements, how they're reported and presented in the financial statements, what's disclosed in the financial statements, and auditors present an opinion on that, provide an opinion on that. With respect to Sarbanes-Oxley, we're all familiar by this current Sarbanes-Oxley Act of 2002. So management's always been responsible for the financial statements. That hasn't changed. What has changed under Sarbanes-Oxley is the fact that now CEOs and CFOs have to sign a statement. And that statement has to speak to the fact that they've read the financial statements, that they're not aware of any false or misleading statements or any omitted disclosures, and that they believe that the financial statements present an accurate picture of the company's financial condition. And prior to Sarbanes-Oxley, this was not required. Why do you think Sarbanes-Oxley required this? What happened that led to this? Given that management was always responsible, why do they now have to sign?
Enron happened, right? Enron happened?
Enron, is that what you were going to say?
Well, I was just going to say maybe management, was responsible, like they said that, oh, we're busy, so we don't have whether or not
Right. So because of the audit failures and management's senior level management, like CEOs and CFOs, response to that they weren't taking responsibility, right? Or, well, we delegate. We didn't know what was in the financial statements, so we can't be held accountable. So I mean, you say, no way, no how. These are your financial statements. So now you have to sign a statement. So it holds management accountable, formally accountable, when they sign the statement, saying that they know. So the idea would be that if someone has to sign their name to something, they have to indicate that I've read it, I'm not aware of any false misleading, that they've actually reviewed it, right, before they put their name to it. So it increases the accountability. The auditor's responsibility, as I said, is to audit those financial statements. And what the auditor is looking for is to identify material misstatements. We talked about materiality somewhat when we went over the Rosie's Diner case, right? Where to some people, 75 cents made a difference to them. They wanted to get their money. Some people are like, oh, I really don't care, I'll just deduct it from the tip, or, it doesn't matter anymore. So auditors have to determine what's material. And so when we cover materiality in about a week or so, we'll talk about this in more detail, how auditors determine materiality and what is meant by materiality. We're not concerned with immaterial misstatements, but there has to be some benchmark to determine what is considered immaterial, and there's no one-size-fits-all. So there's judgment involved in that decision as to what is considered materiality. The auditor provides reasonable assurance. So what do we mean by reasonable assurance? What does that say to you? Yes.
You can't give 100% guarantee that perfectly falls because you're not checking every account, but they're giving the best outcome, out of all the tests that
right. The auditors don't guarantee that the numbers in the financial statements are correct. For one thing, they don't examine 100% of the transactions. So if you don't examine 100% of the transactions, you couldn't possibly say guarantee that, right? But also, inherent in GAAP are estimates. And estimates can vary based on who evaluates those estimates. You could be given the same set of facts, but you might view those facts differently, and you might arrive at a different judgment. So that's why you see Clients come up with estimates on the allowance for doubtful accounts or the obsolescence reserve, for example. Auditors audit those. They might come up with a very different judgment. Right? It could be where you place the emphasis on the, or you could use different inputs, make different assumptions, and so that's going to change that estimate. So inherent in GAAP are estimates, and so because of that, you couldn't possibly guarantee that every number is correct because there is judgment involved in some processes. Auditors also speak to errors versus fraud. So an error is someone made a mistake. Maybe they forgot to sign off on something. Maybe they forgot to book a journal entry. That's an error, perhaps. Fraud is when someone intentionally. So if I forgot to do it versus I decided not to do it because I was trying to cover something up, and I decided not to book a journal entry or I booked a false journal entry because I was trying to cover something up or trying to make my numbers look better. That's fraud. There are two types of fraud, and when we cover fraud, we'll talk about this in more detail, is fraud that results from fraudulent financial reporting. So that's what you've heard a lot in the popular press about management operating within the bounds of GAAP to report more aggressively. So they're using the subjectivity that's inherent in some accounting standards to push the envelope, to report more aggressively. They want to report a higher income number. So maybe they report the lower end of the lower bound of allowance for doubtful accounts. So auditors have to be aware of that. And then there's misappropriation of assets where, as it would suggest, someone steals assets from the company, cash, inventory. So we'll talk about both of those types of frauds in more detail. And then professional skepticism, which we covered today. Right? But one of the things that you will know about professional skepticism is there's no standard that specifically says, okay, this is the professional skepticism standard. Professional skepticism is addressed throughout the standards. It's if you remember when we talked about GAS and the responsibilities of an auditor, looking at standards, that auditors have to have professional skepticism. They should have a questioning mind and the critical assessment of the evidence. So that's an important element of the audit process. So those are the auditor's responsibilities. Related to management's responsibilities are the assertions that management makes about the financial statements. And these assertions are directly tied to generally accepted accounting principles. Basically, managers are making statements that the transactions that are reflected, about the transactions that are reflected in the financial statements, about the amounts that are reflected in the balance sheet, the account balances, the financial condition at the end of the period, and about how information is presented and disclosed in the financial statements. So, for example, GAAP says that we have the back there should be 4 statements that are required: the balance sheet, income statement, statement of cash flows, and the statement of retained earnings. Right? So those are required by GAAP. So that's what you expect to see in financial statements. So every time you pick up a set of financial statements, consistently you're going to see those 4 statements. GAAP also says that financial statements, in the balance sheet, we separate assets, we report assets, liabilities, and stockholders' equity. And the accounting equation, what's the accounting equation? Right. So every time you pick up a balance sheet, that equation must work, right? It has to balance. GAAP says, we report current assets, defines a current asset as, cash, short-term investments, accounts receivable, inventory, those are considered versus long-term assets would be things like property, plant, and equipment, goodwill or intangible assets. And so those are all driven. So what's presented in the financial statements and how it's presented in the financial statements is driven by that. The assertions about classes of transactions represent assertions about transactions that flow through the income statement. So and transactions flow through the income statement, right? What's the difference between a transaction and an account balance? Right. So, and the transaction is the actual event that the company engages in to run their business, right? So they sell goods, they sell services, there are expenses associated with doing that, and that's captured in the income statement. So revenue, if a company engages in a sale, that's a revenue transaction. So those are transactions that result from economic events that the company's engaged in. So when I'm talking about assertions related to transactions, primarily we're going to be talking about income statement, revenue, expenses, things that appear in the income statement. Whereas account balances result because the company engages in transactions. So the sale of goods is a transaction. What's the balance sheet effect? What's journal?
Cash goes up.
Cash, maybe, or accounts receivable.
You have two journal entries, like the cost component, right, when you sell something.
Right, if you're selling goods, right? So you would show the reduction in inventory, report cost of goods sold, reported revenue, and report accounts receivable. But you see, there's a balance sheet impact and an income statement impact when you engage in an economic transaction, right? So the balances are what result. The balances are what we have at the end of any reporting period. That's the accumulation, the net accumulation of the inflows and outflows of transactions. So, for example, when we sell goods, right? Let's say we report accounts receivable. We're going to have accounts receivable. Accounts receivable is not going to be the exact same amount as the revenue account. Why? Well, that, but more, right? Accounts receivable is a current asset. So you're not holding accounts receivable indefinitely, right? So your accounts receivable, you expect to go down. You expect your accounts receivable to decrease, right? Because you expect your customers to pay you. So now we'll talk about how we audit those two accounts later. So what the auditor is doing then is, based on these assertions that management makes, the auditor is trying to gather sufficient and appropriate evidence in support of the assertions that the client makes about amounts reported in the financial statements. So along those lines, that's what we call the audit-related objectives, right? So auditors' objectives to obtain or gather evidence is going to be based on the assertion. So for example, if a client makes the assertion about revenue, that revenue occurred, occurrence is one of the assertions, that revenue occurred. The auditor has to gather evidence to test whether or not that actually happened. Is that a valid assertion? How can I do it? The auditor has to gather evidence to show that the revenue that the client is recording in the financial statements actually occurred. And I'll talk about that in a moment. So we have as I said, we have three classes of assertions that management makes, and related to those assertions are the auditor's audit objectives. So if you look at Exhibit 1.5 in your textbook, you'll see that the assertions are, yes, Exhibit 1.5. So you'll see that there are 5 columns. There are the PCAOB assertions, and then in column 1, and in columns 2 through 5 are the ASB assertions. Or 2 through 4, the ASB assertions. The difference between those two assertions, those two groups, is that the PCAOB really consolidates, it's condensed. The ASB spreads it out over the 3 classes: transactions, account balances, and presentation and disclosure. For our purposes, you're going to make sure you understand the assertions under ASB. Because if you understand the assertions under the ASB classification, the PCAOB classification will be a piece of cake. If you notice, in looking at column 1, under the PCAOB assertions, there are no assertions here that are not in the ASB assertions. Right? It's just that the PCAOB really just combines everything. Okay, so the meaning of the assertions are the same. So for our purposes, always look to the ASB assertions and how. So if I test you on this, I'm going to ask you what class of assertion is this? So if I give you a question about revenue, you should automatically know I'm talking about transactions. Why? Because revenue flows with the agency. That's a way to kind of think of it. And a transaction flows with the agency. Right? Think about it, it's your statement of operations. What are your operations? That's the economic transactions that you've engaged in for that period. Right? It goes to Exhibit 1.5 it breaks it down nice so that you can see the difference between the two. So let's start with managing assertions about transactions. And I'm going to use revenue as an example of how I walk through different transactions. So one of the first assertions is occurrence. And basically what occurrence is saying is that management is asserting that all of the transactions reported in a financial statement are valid. If these are valid transactions, they occurred and they were shipments made to non-fictitious customers. So let's talk about the relevance of those two things. Shipments made to non-fictitious customers. So when we talk about revenue recognition, what are the characteristics under GAAP for recognizing revenue? In, let's just say, in an environment where you sell goods to a customer.
Revenue is recognized until the goods are delivered to the customer or shipped out.
Ship, right? It depends, right? So it could be freight on board or freight destination, right? But what does that mean? You can't. There's some other elements to revenue recognition.
Recognize when earned.
Right, so but how do you determine it's been earned?
Transfer of ownership.
Transfer of ownership. And one measure of that is that you ship the goods. What else? Right, but that would be the ownership, right?
You shipped exactly what was ordered to somebody.
Well, that kind of gets to accuracy, right? That's true. Right, you have to have a reasonable expectation that you're shipping to a valid customer, right? You can't ship to a non-fictitious customer because if you ship to a non-fictitious, now you ship the goods shipped, it left your premises, you shipped it somewhere, right? So if it's a fictitious customer, right, then you don't have to sell. There's no revenue because it's not a real customer. It just shipped somewhere. You have to have a reasonable expectation of collectability. Right? So some of the things that auditors, and I'll get into this more, but some of the things auditors will look at is, these goods were shipped. Well, they're going to look at returns, right? Because if there's indication that the client is just shipping stuff out so they can boost their revenue at the end of the reporting period, and then, a month later you're seeing these huge numbers of returns after the reporting period ends, then the auditor is going to question whether or not that revenue has indeed been earned, right? Because there might not be an expectation of collectability that the customer is going to pay. So go back and take a look, and this is going to be important. Make sure you understand. So go back to your financial accounting textbook and make sure you understand what the criteria will be to recognize revenue. When do we know? How do we measure revenues earned? But, so let's just say, in our situation, for occurrence, what the auditor is going to test is that a shipment was made, and the shipment was made to an approved customer, a valid customer. So they're going to, in other words, look at the amounts that are recorded in the sales journal, right? That's the sales master file. And then trace those to shipping documents. Now, this is assuming, because there are numerous steps, and we'll talk about those more when we talk about auditing and revenue assignment. So, assuming that controls are effective and that goods are only shipped once it meets all of the control objectives that the company has in place. So, assuming that controls are effective, and auditors say we can rely on the fact that these shipping documents are valid, they're going to then go from the sales journal to shipping documents. And that's how they determine that that's a valid sale. Because once it's shipped, it represents revenue to a valid customer. So all goods that are reported actually occurred. Completeness says the opposite. Completeness is interested in everything that should be reported has indeed been reported. So what do you think the auditor's concern is there with completeness?
Maybe returns?
Not really, because returns we kind of deal with separately. So this is just dealing with what's because right, returns are recorded as a contra account, revenue account, right? You show returns in a separate account. So the auditor at this point is just auditing the revenue account. So we'll look at returns later. Everything that should be reported is reported. What if
Maybe like inventory write-off,
but that doesn't have anything to do with revenue, though, right? The revenue account. Let's just stay with the revenue account. What happens if something's not reported? What if you sell something and you didn't report the sale? What does that do? Understatement. Revenue is understated, and that has what on.
Like, wouldn't your expenses be higher?
Not necessarily. What asset? The profit journal entry. You didn't report it. Well, everything. Revenue is understated, right? Accounts receivable would be understated. And what's the impact? Where's revenue reported? Reflected in the financial statements.
On the income statement.
And so,
It's on the income.
right, your net income would be understated, right? Well, yeah, if the management has incentive to do that, right? That might be one of the reasons. So your net income will be understated, right? So you're concerned about understatement. Completeness addresses understatement of revenue. Everything that should be reported has been reported. That's what completeness is. Whereas a reported should be reported. What is that about? If completeness is concerned about understatement, what would occurrence be concerned, trying to address? Overstatement. Right? Because if you're reporting revenue that did not, and you don't have a shipment to support that, then your revenue is overstated. What do you think is riskier from an audit perspective? Overstatement, right? Overstatement. Okay. So with revenue, when we talk about occurrence, and I spend more time on these two because these are, especially occurrences, very important, and as you correctly stated, is risky. So for occurrence, we want to know that everything that has been that's reported in the financial statements or in the sales journal is valid. So we select a sample of items from the sales journal and tie those back to the shipping documents. For completeness, we go in the opposite direction because what we want to know is that everything that should be reported. So shipments are the basis in which you say this is a valid revenue transaction and we should report revenue. Then we want to start with the shipping documents. So we're going to take a sample of shipping documents and go and tie those to the sales journal. So we're using the same two pieces of evidence, but how we test those and the samples that we select are different. Right? So with one, we select a sample from the sales journal. The other, we select a sample from the shipping document, and we go in opposite directions. That's how we would know that everything we saw from the shipping document, everything that should be reported is indeed reported. So let's finish up here. So accuracy is just as it indicates. I think the transaction's been reported at the correct amount. The audit-related objectives, so auditors are going to want to make sure that the transaction is reported at the right amount, that the transactions are summarized properly in the master file, that they're correctly summarized. Because remember, your sub-ledgers roll up to your general ledger. So you have to make sure that the sub-ledgers are reporting the correct amount, because that's your amount of these general ledger. Classification deals with whether or not the transactions are reported in the right account. So in other words, when you're reporting sales to customers, that's reflected as revenue. Sales of fixed assets should be reflected as other income. It should not be in revenue. Because your general business is not selling fixed assets, right? In this case, in the example. So say your business is that you sell books. Right? So any book sales are going to be reported in revenue. Sales of fixed assets will be reported in other income. So auditors will want to make sure that those transactions are properly classified. And then cutoff deals with timing of the transaction. We want to make sure that the transaction is reported in the proper period. And the auditor is concerned with the timing of those transactions, and they have to be reported on the correct dates. So this becomes a bigger issue around quarter ends and especially around year-end when you're reporting. Right? Because you want to make sure that all of the transactions that are reflected in the financial statements occur on or before December 31st, if December 31st is your year end. So auditors will perform tests around cutoffs. So the dates are going to, the transaction date is going to be extremely important. That's why you look for controls around. So any questions about transactions? So these are the five assertions related to transactions and the audit, the general transaction related audit objectives. 6. Questions? Okay, so let's talk about account balances. Assertions about account balances. So the assertions related to 4 assertions related to account balances deal with the first, existence. So that amounts reported in the accounts, that the amounts are reported exist, right? So the assets, liabilities, interest, equity exists. So let's say with the revenue side, accounts receivable. The auditor is going to perform procedures and gather evidence to determine whether or not the accounts receivable exist, that they are valid accounts receivable. Actually, we'll change it. Not so much, but they are, as of the reporting date, that that's still an accounts receivable balance that the client has outstanding. That's outstanding. So, why, I have a question. Why is it not enough? Because we know that when you report a sale, you debit accounts receivable and you credit revenue. Why would the auditor then have, if the auditor audits revenue, why or why not? Why would they need to do more work or why not? On accounts receivable. By auditing revenue, do you have enough information about accounts receivable? Do you have enough evidence? Why or why not?
Because of time, like people are less likely to pay over a long period of time. Right?
What
It's
time?
been outstanding, right?
You're right about timing. Yes, you have two elements here. One is timing. So at the time of the transaction, when you reported the sale, yes. But you expect that people are going to pay. So your revenue account reflects that sale, as it should. Your accounts receivable balance will no longer, if that sale has been paid, if that receivable has been paid, then it's no longer going to be there. You expect that. So it's never, so you have to perform procedures, or gather evidence, I should say, about accounts receivable independent of auditing revenue. That's just one side of it. What else about accounts receivable? Yes. The allowance without accounts. Right? So there's an element of accounts receivable that has absolutely nothing to do with revenue. It deals with the collectability of that receivable and the allowance without accounts. So the auditor is going to make sure that, or gather evidence about whether or not accounts receivable exists. One thing they might do is confirm standard requirement, standard audit procedure is to confirm accounts receivable. Confirm accounts receivable with the customer. Another is completeness, means the same thing. Existing amounts are included, so things that should be included in the balance is indeed included in the balance. Valuation and allocation, assets, liabilities, equity are included in the financial statements at the appropriate amounts. And any resulting valuation adjustments are appropriately recorded. So again, when we're talking about allowance accounts receivable, the valuation adjustment would be the allowance without the accounts, right? Because the allowance without the accounts requires, accounts receivable is to be recorded at its net realizable value. Right? That's what that tells us. And that means it net of allowance without the accounts. What the auditor is concerned with are five objectives. They want to make sure that it's accurate, the amounts are accurate, that they're properly classified. So accounts receivable should be trade accounts receivable. Those accounts receivable resulting from selling to customers. Cutoff, the transactions are recorded in the proper period. That the detailed timing, that the account balances agree with the master file and with the general ledger, and then their realizable value. That assets are included at their estimated realizable value. In the case of accounts receivable, the allowance without the accounts. In the case of inventory, obsolescence, netted obsolescence reserve. And then finally, rights and obligations, that the assets, liability, the assets are the company's assets, they have rights to those assets, the obligations are the company's obligations, and so forth. So auditors, again, want to make sure that assets are owned by the company. So in other words, you can think for example, in some industries, accounts receivable can be factored. In other words, companies will take out a loan against their accounts receivable. They'll borrow money against their accounts receivable. So when those receivables are collected, that money is owed to the person that they borrowed from, the company that they borrowed. That information has to be reflected in the financial statement. That's considered most times you'll find auditors will find information about that just from reading the board of directors. Okay, so that's account balances. Do you see the difference in the assertions? Do you understand why an accounts receivable balance? Because on the sales side or revenue side, you're testing the occurrence of the transaction. So that gives you information about how that accounts receivable was generated. So you have evidence that it's a valid accounts receivable based on your testing of occurrence in testing revenue. But then you have to determine, well, okay, I know how that receivable was generated. Does it exist? Has it been paid? Is it collectible? All right, any questions about account balances? All right. So let's just quickly review presentation and disclosure. I'm going to spend less time talking to you about it, but basically the assertions are those assertions related to how information is presented in the financial statements and how information is disclosed. Occurrence and rights and obligations, same as we talked about in the previous two classes of assertions. Disclosed events and transactions have occurred and they pertain to the company. Completeness, the same. Everything that should be included, all disclosures that should be included have been included in the financial statements. That is accurate, that the information is disclosed appropriately and at appropriate amounts, and that the classification is appropriate and understandable. Think about disclosures. Disclosures are meant to provide additional information about amounts reported in the financial statements. So they should be presented in a way that users of the financial statements understand the disclosure, right? What the company is trying to convey with that disclosure. So those are your three classes of management assertions. So when I test you on these, and assertions is something that we're going to cover quite extensively as we go through the various cycles, the financial statement cycles. We will cover assertions over and over again. So this will hopefully become just kind of intuitive as we go. I pointed out the PCAOB assertions already exhibit one, so let's move past that. So let's do a knowledge check. So how many people think A? How about B? How about C? How about D? So that means about 50% of the class think the answer is not there. Okay, so what's the rationale? Say A. What's the rationale?
I think it's kind of similar to accounts receivable in the sense that you have to report what liabilities that exist that you have responsibility for in your statements, and also that what actually happened got reported, and also what was reported actually was there.
Okay. So you're saying that when the transaction occurred, we're talking about accrued liability, so this is an account balance. So occurrence would be that would be because accrued liabilities is a balance sheet account. And then existence that, so let's just take a look back at existence. That the accrued liabilities exist. And so, and as you can just that's important. So the one thing that I want to say is that assertions for all clients, right, these assertions apply. It's just that when you're trying to gather evidence for certain assertions, your procedures are going to be different. So for every account, you're going to, every cycle, you're going to have the assertion. So what this question is getting to, so let's people, okay, so so auditors are going to be most likely focused on the existence of the accrued liabilities. Who said? What's your rationale?
Well, I guess liabilities, in case something was going wrong, maybe one client's not do everything.
Okay.
So I think it's a goodness because everything that should be recorded is actually recorded.
Okay. And I think there was someone who said C.
Yeah, I think when I was thinking of liabilities, I think it reminded me of like intermediate two, where you have like certain liabilities that you have to estimate or things of that nature, or like a lawsuit pending or something. Like
So
that.
did you say C or D?
I said C.
Because what you described is evaluation and estimate. Okay. Right? Because think about what presentation and disclosure is. That is presented properly, that the information is disclosed in the financial statements. So remember what I said in this class. This audit is risk-based. So I need you to think risk when we think about these things. Right? Yes, Adrian. Right. And the reason that the primary focus is going to be completeness versus existence, it's not that existence isn't important. The primary focus is exactly as Philip indicated and AJ, is that you're concerned that things that should be reported have been reported. Accrued liabilities, by the nature of accrued liabilities, a lot of times they can involve estimates, right? Or they can also involve, you want to make sure that, for example, you're reporting that liability because you've incurred the expense before you're actually billed for the expense. So let's say, you know that you have to pay legal fees, right? So you know that you've incurred these legal fees during the month of December. The lawyer performed the service for you, but that attorney has not billed you yet. You have to report the expense, right? Because you incurred it. You incurred that expense in the month of December. So now so maybe you don't know what the exact amount is, so you're accruing for it. And you know that you're going to have to pay legal expense, you don't know what the exact amount is, so you set up an accrued liability. Right? Or you have payroll. If you pay your employees on the 1st and the 15th every month, you're not going to pay your employees until January 1st. But they earned the salary from December 16th to December 31st. You have to accrue that amount. So when an auditor is concerned with liabilities, is that management might not have reported all liabilities, especially when they're accrued liabilities. When we talk about the expenditure cycle, this will be more evident to you, right? Receiving, you could have received something on December 31st. Well, if you received items, you're now legally responsible to pay for that. You've incurred a liability. Just as we record revenue when we ship goods, we record liabilities when we receive something, when we receive goods, right? So if you receive those goods on December 31st, do you owe money on December 31st? As of December 31st, do you have a liability? You receive it. Yes. So you have to report that. That's accrued. So you're more than likely going to. So auditors are going to look for things like that. They're going to test for, they're going to search for unreported liabilities because they're concerned with the search for unreported liabilities. In conducting the search for unreported liabilities, is that there are liabilities that should be reported that have not been reported. And if it's not been reported, your liabilities are understated on your balance sheet, and your net income is overstated because you haven't reported the expense. Make sense? So that's why it's B. That's the primary. So, how do you think A? B? C? D? E? Okay. So, did I see a lot of hands for D? C. Okay. So why C?
For video, adding additions to fixed asset, maybe she wanted to repair maintenance expenses so she can follow the evaluation process. So that maybe like the addition extended the useful life of the fixed asset. So I guess we won't be able to allocate.
So with the valuation, let's take a look at that. So what's the valuation? What it's because we're talking. So what's the primary focus in this? In that? What's the auditor's primary focus here? Yeah.
Is to make sure that expenses are not understated. So I guess if you come with this, they are trying to make sure that an account is not understated.
Okay, so
I was gonna say it's revenue because expenses go to the income statement.
it's revenue? No, but of these choices, it's
Valuation or allocation, we'll go with the matching principle because we want to make sure that the expenses are matched with the revenue at the time of the audit.
okay. So you think your auditor's test here is that they're reviewing the additions to the fixed asset account. So what they're trying to do, so the additions to the
I thought C was they're trying to classify specific additions to fixed assets we have, but actually.
so you say, so you're changing your answers.
I had a version of C.
C.
But for the audit side, classification, additions into fixed assets, that's what they're doing.
Right. So what they're doing, right, is they're looking at fixed assets and additions to the fixed assets. You only want to see additions to fixed assets if they extend the useful life of the asset, right? It's if they are just maintenance, then they should be in repairs and maintenance. Right, so what the auditor's concern is here is to make sure, one, that the additions are valid additions, right? That they're not repairs and maintenance. So the focus is on the balance sheet. It's on amounts that impacted the balance sheet, right? Because what they're concerned with is that there's nothing in here that should be recorded as a repair maintenance. That the additions reflect true additions to under GAAP classification, that they represent an expenditure that extends the useful life of the asset. So the focus is on what's reflected in the balance sheet. Right? And so if they were to, they're not auditing the income statement. They're auditing the balance sheet. They're auditing something that's reported or reflected in the balance sheet and making sure that it has not, that it is indeed a valid addition, that it should be in a fixed asset account. So that's existence. So they're testing the existence of these. This is a test of existence. Right? Because an addition has to, you're just not going to put an addition up, it has to pertain to a particular asset. You're extending the useful life of some asset. Right? Because if you think about some of the things that, one of the accounting failures was WorldCom, right? And what was WorldCom doing? It was capitalizing basically repairs and maintenance. Right? They were capitalizing expenses that had in no way, shape, or form extended the useful life of a particular asset. And so when an auditor is reviewing the additions they want to make sure that the additions are valid, obviously, they are, but that the asset that they're assigned to an asset, right? They're related to an asset and they're extending the use. They are classified as extending the useful life of that asset. So the asset obviously has to exist. So what they're evaluating is the addition, not repairs and maintenance. They're not trying to determine the balance in repairs and maintenance. They're trying to determine the characteristics of that addition, that it is a valid addition that extends the useful life of an asset. So the focus is on a balance sheet account, not the repairs and maintenance. Questions? So we're going to go through this, as I said. It's first glance. I know it seems like it can be a number of things. So that's why we will go through a lot of these kind of knowledge check questions as we go through assertions. Okay. All right. So, and I also suggest that I posted, practice problems on Connect and See It by chapter. I strongly suggest, especially as this first pass of assertions, that you work on those practice problems and try to help you think through, what the question is asking. Right? Because assertions are, and as we move along, I'll give you an audit procedure, and you're going to have to be able to identify what assertion that audit procedure is testing or gathering evidence about. So, for example, when I gave you I talked to you about occurrence, I said the audit procedure that the auditor will perform is to take a sample of transactions that occurred in the sales journal, recorded in the sales journal, and tie those to shipping documents. And for completeness, it's in the opposite direction. So you want to get comfortable with being able to tease out exactly what the audit objective is, to be able to identify the assertion. Okay. Any questions about assertions before we move on? I know we digest. reason that we're auditing, we're giving auditors giving an opinion on the financial statements. In order to do that, they have to collect audit evidence, and their work, that audit evidence has to be documented in the work. So let's talk about the audit evidence. So I already talked about what the audit objective is. The auditors are expressing an opinion on financial statements. They express an opinion with respect to the company's financial position, which is the balance sheet, the results of operations, which is the income statement, and the statement of cash flow. And they do this in conformity with generally accepted accounting principles. So remember, the assertions are directly tied to generally accepted accounting principles. I talked about this one. So the way we're going to, and the way audits are performed is the client, a company has several transactions, different areas, and so you break the audit down into, or the financial statements into smaller segments. So this is how we're going to approach it as well. So in this class, we're going to focus on the sales and collection cycle and the acquisition and payment cycle. We're not going to cover, we just don't have enough time to do that. The payroll, inventory, capital acquisition, and payment cycle. We're not going to do that. We're not going to cover the financing cycle either. So you break the financial statements down into smaller segments, and then you audit the accounts related to those components. So, for example, if we were to look at the relationship between the cycles and the financial statement accounts, so taking the first row, sales and collection. So when we talk about sales and collection, we're talking about the revenue process, right? So the client is generating, selling goods to a customer, and then they collect on those goods, they create accounts receivable, collect on those goods. So the balance sheet accounts that you tend to find that are generally in this cycle would be accounts receivable, cash, notes receivable, trade, the allowance for doubtful accounts, and interest receivable if applicable. Whereas in the income statement, you're looking at revenue, sales, bad debt expense, and interest income, and also sales returns and allowances. And those are shown separately. Sales returns and allowances. Similarly, you'll look at the acquisition and payment cycle, and you'll see a number of payable accounts, such as accounts payable, income taxes payable, cash, and inventory, right? Because inventory is generated because we purchase goods that we're going to then resell. Do something with the manufacturer, we'll then sell those goods. So accumulated depreciation, inventory, and then different expense accounts would be things like income tax expense, think about your operating expenses, advertising expense, depreciation expense, rent expense. So that's what. So an auditor will break it down, break the financial statements down into business cycles, and then look at the accounts associated with those particular cycles. So in order to gather audit evidence, we have to perform audit procedures. And the audit procedures are how the auditors gather evidence to test whether or not the specific assertions of occurrence, completeness, existence have actually been met, right? Because management makes assertions about it, auditors gather evidence. We're going to talk about each of these in the next couple of weeks. These risk assessment procedures. So the risk assessment procedures are largely related to the audit risk model. And as I said before, the audit approach is a risk-based approach. So auditors assess risk. Based on that risk assessment, they design their audit approach. Right? And so the key elements of the risk assessment, the key element of the risk assessment process is the audit risk model. And we'll also talk about the auditor's responsibility for fraud risk assessment. The auditors also perform test and controls. So assuming that they can rely on the client's controls, if they assess, because part of their risk assessment procedures is to assess control risk. So in other words, how effective, it says how effective the client's system of internal controls, how effective is the system of internal control. And based on that, if they determine that control risk is low, meaning that the client's system of internal controls is effective, then they're going to test controls. And that's that. And then auditors also perform some standard procedures. So your tested controls are audit procedures that the auditors perform to ensure that controls are operating as intended and operating effectively. So for example, a control that a client might have, a standard control in the acquisition and expenditure cycle, is that before a cash disbursement is made or approved, there must be a three-way match. And that three-way match, before you can, a payment can be made, is that you have a purchase order, meaning that an authorization to purchase those goods, a receiving report, indicating that you actually received the goods, because now that creates a liability, so you're liable to pay for those goods. And then a sales invoice, that you've been billed for those goods. And based on those three documents, that'll be authorization to issue a cash disbursement or write a check. Right? So that's an example of control. So auditors would then select a sample of cash disbursements and ensure that for the cash disbursements reported in the cash disbursements journal, there's an appropriate three-way match. All of the documents that should be in place to support that disbursement are indeed there. So that's an example of a test of control. A substandard procedure is a test of account balances. Test of account. So for example, a substandard procedure would be confirming accounts receivable balances. So you want to test the existence of accounts receivable, you would confirm. So you issue a confirmation to customers. Select a sample of accounts receivable customers and confirm the accounts receivable balance reported in the client's accounts receivable balance. So that's an example of a substandard test procedure, a substandard audit procedure. So during as we're going through the course, these are some typical audit procedures or types of audit procedures. Inspection of records and documents, such as vouching, tracing, and scanning. You see those terms associated with that. Inspection of tangible assets, so fixed assets. Observation, observing, as it would apply, observing. So you might in testing controls to see if the control is operating as intended. If a client has a control that everyone has to get their time card stamped, and you could observe whether or not people, if they walk in, they check in each day or report to work each day, that they stamp their time card. You might observe to make sure, for example, that you're looking for fictitious employees. You might observe the payroll process as let's say, the warehouse supervisors passing out paychecks. You might observe that process to make sure that paychecks are being given to valued employees. Inquiry is as it suggests that you're asking questions of the client about information that's reported in the financial statements, about their assumptions that they assign to estimates that they made, about the control procedures that are in place. I talked about confirmation, those are third-party confirmations, where you send a confirmation, you confirm accounts receivable to the customer. Recalculation is as it implies. Reperformance is the same thing as it implies you reperform something that they describe what they do. And analytical procedures we'll talk about in more detail next week. But analytical procedures are you're looking at changes in the financial statements. It could also include about assessment or ratios. You've done financial ratios financial ratios, current asset, current asset ratio, or the current ratio, I'm sorry, or debt to equity, or accounts receivable turnover. Those all perform those ratios for a reason. So auditors use that information to, in the planning stage at least, it's attention directed. So you're looking to see if there are any patterns or changes in the financial information that might suggest a risk, a higher risk. Okay? So for example, if you look at the relationships between accounts, so that's the importance of knowing in each cycle what the accounts are and how those accounts interact. Right? So if you see an example, like I gave this before, where accounts receivable is increasing, but revenue is going down. Right? That doesn't seem to be a natural, relationship. Right? So it could be that they're not collecting on their accounts receivable, and if they're not collecting on their accounts receivable, then that might mean that the allowance for doubtful accounts. So you want to see that the allowance for doubtful accounts is increasing as well. And if allowance for doubtful accounts is not increasing, that could be a risk, right? It could be that their allowance for doubtful accounts is understated, and as a result, accounts receivable is overstated and their allowance for doubtful. Or it could be that they change their payment terms. Right? So at the very basic level, the analytical procedures are attention directed. So they're going to direct your attention to a possible misstatement or a possible risk area, and which you follow up on, at least in the plan stage. We talked about assertions. So again, to tie the assertion to the audit procedures process, let's give an example of the audit program for accounts receivable. You're going to test, these are all of the management assertions related to an account balance. And so an auditor would then perform these procedures to test that those assertions are met. So as I said before, existence, they want to make sure that the account receivable exists. So your audit procedure, standard audit procedure, confirm with the customer. Rights and obligations, you want to make sure that the client has the right to those accounts receivable. They own those accounts receivable. So the auditor would inquire if receivables have been sold or pledged. You ask management about it. You look at the board minutes to see if there's anything in the board minutes that talk about that. Or you could look at agreements. Completeness. Everything that should be reported has indeed been reported. Agree the control total with the subsidiary account. You reconcile that. Because at this point, you've already tested controls around this. And so assuming that you did test controls and the controls are effective, then you can now perform this procedure without, there being figures and error. Shipping documents, select shipping documents immediately prior to year-end and after year-end, right? Because you're concerned here about cutoff, the timing of what transactions, so that those transactions, you know that the accounts receivable balance, it consists of transactions that occurred on 12/31 or before 12/31. Then valuation and allocation, we're talking about the allowance for doubtful accounts. So you want to trace amounts from the A trial balance to the subsidiary account, and then you want to test the adequacy of the allowance for doubtful accounts. So it's not enough to know that they aged it, but the percentages that they signed to the aging, is that correct? Is that representative of past history, for example? Presentation and disclosure, one of the things you're concerned about is related party transactions, and you also want to, because you are gaps you should disclose information about your accounts receivable, you want to evaluate the disclosure, the information that's disclosed in the footnote. So that's just to show that your procedures are going to be developed or used to try to gather evidence about assertions that